Have you ever, meticulously planned your budget, maybe analyzed investments, built those spreadsheets, only to find that when it comes to actual money decisions, things feel, well, a bit less than perfectly rational? Or maybe you've wondered why some people, even earning loads, seem to constantly struggle with money stress, while others, maybe with less, just seem to navigate it all with, I don't know, more peace.
It's a common puzzle, definitely.
Well, today we're taking a deep dive into exactly that, this fascinating, sometimes confusing world where our human behavior crashes right into our finances. Our guide for this is Morgan Housel's brilliant book, The Psychology of Money. And we're not just talking economic theory here.
No, not at all.
We're going beyond the numbers, beyond the charts, really trying to get at why things happen with money, not just what, tapping into that, that human factor that so often gets left out.
And what's so great about Housel's work, I think, is his main point. Our financial choices. They're rarely driven by those neat, tidy economic theories, or even what we say we'll do. Instead, he shows how they're shaped by all this messy human stuff. Our personal histories, like what we learned growing up, pride, envy, optimism, even just plain luck.
Yeah.
And the results are often really surprising, kind of counterintuitive sometimes. It's not just about spreadsheets, it's about people.
Exactly. And that's why this deep dive matters so much to you. We're kind of offering a shortcut here to understanding these hidden forces playing out in your own financial life and, well, everywhere around you. We're hoping for some real aha moments, insights that might actually shift how you think about wealth or success or even greed and happiness when it comes to money.
Yeah, definitely.
We'll dig into some surprising stuff, like how your experiences when you were young can lock in your investment strategies for decades. Or this idea that finding one amazing Picasso might mean you bought, like, 99 duds first.
The long tail.
And, yeah, how envy can make even super rich people risk absolutely everything. So get ready. We're looking at money through a fresh, very human lens today.
Sounds good.
Okay, so let's unpack this. Housel kicks things off by challenging this assumption we often make, right? That there's this single objective way the economy works for everyone, a shared reality.
Yeah, like we all experience recessions or booms the same way.
Exactly.
Yeah.
But what if our personal histories, our own unique stories, are actually way more powerful? What if they create totally different financial worlds for each of us?
Well, that's precisely his point. Think about the Great Depression. The standard story, the one we all kind of learn, is bleak. Stock market crashed 29, then a decade of just grinding decline.
Right. Businesses folding, farms lost, savings wiped out, poverty.
Exactly. And that story is absolutely true for millions. It was devastating. But Housel points out that narrative, while dominant, misses the huge variation in individual experiences. It makes you ask, okay, whose depression are we talking about?
Yeah. And he uses this incredibly powerful anecdote about John F. Kennedy. When JFK was running for president in 1960, people asked him about his experience of the Depression.
And his answer was revealing.
Totally. He basically said his family, already super wealthy thanks to his dad, Joseph P. Kennedy, their fortune actually grew during the 30s.
Right. Joe Kennedy famously got out of the stock market before the crash, invested cannily during the downturn.
So by 1939, the Kennedys had more servants, a bigger house. JFK himself only really learned about the widespread suffering by reading about it later at Harvard.
It's just a completely different reality. And the implications, Housel argues, are huge. It's not just rich versus poor, though that's part of it.
Right.
It's that these vastly different experiences teach profoundly different lessons. Lessons about risk, reward, security, what money even means.
Yeah.
Think about the kid whose family lost the farm versus, Joe Kennedy's son.
Yeah.
Their whole financial worldview, their gut feelings about money, they're forged in completely different fires, and those feelings stick.
Absolutely. And this isn't just history. You can see it today, right? Housel suggests even people with similar incomes now might have totally different approaches based on, say, growing up with high versus low inflation.
Right. Those early experiences, they just seep in.
It really drives home his idea that, we know less than we'd like to think we do about how the world works for other people. Our own experience feels like the reality, but it isn't everyone's.
It's a crucial starting point. Our lens is powerful and often invisible to us.
Okay, so if our personal lens shapes everything, that leads to this next really interesting bit. Housel explores the illusion of rationality. Or
Yeah.
maybe when something looks illogical, it actually makes perfect sense for that person.
Yeah, the economists love their models of the rational actor, right? Making perfectly self-interested, maximizing
Oh, it
choices.
is optimizing.
But Housel says, nah, reality is way messier. It's driven by feelings, by context, sometimes just desperation.
Yeah.
He says if you really want to get why people do things with money that seem, well, crazy, like burying themselves in debt or gambling or blowing fortunes, you can't just look at interest rates.
You need more than spreadsheets.
You need to understand the history of human emotions. Envy, greed, fear, hope. That's what's really pulling the levers.
And he gives this really stark example, the lottery paradox. He points out that the average low-income household in the U.S. spends something like $411 a year on lottery tickets.
Okay.
But here's the kicker. At the same time, about 40% of all U.S. households, often in that same demographic, say they'd struggle to find $400 for an emergency.
Wow. Okay, yeah, that sounds completely backward from a purely financial planning perspective.
Right.
Save for the emergency first, right?
That's what the textbook says.
Yeah.
It looks totally illogical, prioritizing a massive long shot over basic security.
And this is where Housel is so insightful.
Yeah.
He argues it's not illogical from their perspective. If you're living paycheck to paycheck, if you don't see any other realistic way to, fundamentally change your life, that lottery ticket, however slim the odds, it offers a shot, a tangible possibility of something drastically better. It's buying hope.
Hope that, say, saving $10 a week just doesn't provide in the same way.
Exactly. Traditional financial advice, incremental savings. It can feel pointless if your goal is escaping serious hardship, not just building a small cushion. That $411 might seem like a bad investment numerically, but emotionally, it's buying a dream, a vision of possibility that feels totally out of reach otherwise.
That really reframes it. It's about the emotional return, not just the financial one. And what's powerful is how Housel shows this isn't just one anecdote. Personal experience driving decisions is fundamental everywhere.
Yeah, he brings in actual research here. There's this 2006 study by economists Malmendier and Nagel. They dug through like 50 years of data from the Survey of Consumer Finances.
Looking at what people actually do with their money, especially investments.
And their big finding, it connects right back to what we were saying. What primarily determines how people invest their risk tolerance, what they buy, is what the economy was doing when they were young adults. Those formative years.
Seriously. So like your teenage, early 20s experience.
Yeah. For instance, if you lived through high inflation then, you are super unlikely to invest heavily in bonds later on, even if inflation totally cooled off. That early fear just stuck.
Wow.
And the reverse. Low inflation growing up, you're comfortable with bonds. Same with stocks. Strong market early on, you're more likely to invest in stocks later. Weak market, you tend to avoid them, regardless of what the market does later.
So the decisions become rigid. Like later evidence doesn't really change that gut feeling you formed way back when.
Pretty much. Housel gives the example of someone born in 1970. They saw the S&P 500 go up tenfold during their key formative years. Huge bull run. Compare that to someone born in 1950 who saw mostly flat or rough markets during that same life stage.
Completely different lessons learned about risk and reward.
And those lessons become deeply embedded, often unconsciously driving choices decades later. It's a feedback loop from the past. The challenge is recognizing those biases in ourselves, right? Trying to make choices based on today's reality, not just old programming.
Okay, so our experiences shape us deeply. But then Housel throws in another curveball. What if the financial systems themselves, the very concepts we use, are so incredibly new that our ancient human brains just haven't caught up?
Right. We tend to think of money, banking, investing as these ancient pillars of civilization.
Like they've always been here.
But Housel argues, and it's pretty compelling, that many of the core economic ideas we live by are, in historical terms, infants. They're brand new toys for our Stone Age minds.
He uses that great analogy about dogs.
Yeah, the dog domestication analogy. He says, look at a modern dog breed. Maybe a poodle. Looks nothing like a wolf, its ancestor. We've selectively bred them for 10,000 years. But even after all that time, your poodle still goes nuts chasing squirrels, right? That deep-rooted predatory instinct is still there. 10,000 years hasn't wiped it out. So Housel applies that to money. If we seem bad at long-term planning, prone to panic selling, whatever, it's not because we're fundamentally irrational or crazy. It's because our brains haven't had evolutionary time to adapt to these super new, super complex financial concepts.
We're running ancient software on modern hardware.
Yeah.
Or maybe the other way around. Ancient brains in a modern financial world.
Exactly. And when you actually look at the timeline Housel lays out, It's kind of stunning how new some of this stuff is.
Like currency itself. The first coins, only around 600 BC in Lydia. Before that, it was barter or shells or whatever.
Relatively new in the grand sweep of human history. And then you get to more complex stuff, like retirement.
Oh, yeah. The idea of just stopping work and living off savings.
Before World War II, most people just worked until they dropped, basically. Even in the 1940s, half of men over 65 were still working. Retirement as a widespread, attainable thing for the average person. That didn't really happen until maybe the 1980s in the U.S.
When Social Security checks got big enough to actually live on for many.
Right. Before that, it was a luxury for the few.
That's mind-blowing. The whole concept of a 20, 30-year retirement is barely 2 generations old for most people. And the tools for it, the 401k,
Didn't exist until 1978.
and the Roth IRA, 1998.
I know, some of these bedrock retirement vehicles are younger than many of the people using them.
It's wild.
And it keeps going. Hedge funds in their modern form, maybe 25 years old. Index funds, only about 50.
Even widespread consumer debt mortgages for regular folks,
Yeah.
car loans, credit cards everywhere, that really took off after the GI Bill in 1944.
Before that, borrowing was much harder for the average person.
So the big insight here is, if we feel overwhelmed or make what seem like bad financial choices, maybe cut ourselves some slack.
That's Housel's point. We're greenhorns novices using brains evolved for immediate survival in the savannah to navigate things like compound interest and tax diversification.
Yeah.
It reframes our struggles. It's not necessarily a personal failing. It's a collective learning curve, a mismatch between our biology and our very recent economic structures.
How can we expect flawless navigation of systems that are just decades old, using brains that are millennia old?
Exactly. It encourages a bit more empathy for ourselves and others. We're all learning this new game together, essentially.
Okay, so our brains are ancient, the tools are new, our personal history biases us.
Yeah.
Where does simple luck fit into all this?
Luck. The great unmentionable sometimes.
We love to think success is all skill and hard work.
Yeah.
And failure, that was just bad luck.
But Housel really emphasizes that luck, both good and bad, plays a huge, often unacknowledged role in financial outcomes, far more than we like to admit.
He mentions asking the economist Robert Shiller, the Nobel laureate, what he most wanted to know about investing that we can't know.
And Shiller's answer was basically the exact role of luck. How much is it really responsible for success? It's so hard to pin down.
And we feel weird attributing someone's success to just chance. It feels dismissive.
Right, so we tend to downplay it or ignore it, which, Housel argues, is a big mistake.
He also brings up this fascinating finding from economist Bashakar Mazumdar.
Yeah.
Get this. Siblings' incomes are more closely correlated than their height or weight.
Wow. Say that again?
Yeah. If your brother is rich and tall, you're statistically more likely to be rich than you are to be tall like him.
Okay, that really speaks volumes about, well, the luck of the draw in terms of family, environment, opportunities, things largely outside your individual control. Challenges that pure meritocracy idea.
Definitely. And it ties into this psychological blind spot Housel highlights. Our own success, that's skill, smarts, grit. Our failure, bad luck, external factors.
Uh-huh.
But for other people, their success is skill too. But their failure, oh, that's a character flaw. Laziness, bad judgment.
It's that classic self-serving bias, isn't it? Makes it almost impossible to objectively see luck's role anywhere. We overestimate our own control.
And our culture feeds this, right? Think about magazines like Forbes. They celebrate the winners, the billionaires, the bold investors who struck gold.
Yeah, those heroic narratives.
You don't read many cover stories about the brilliant investor who did everything right but got wiped out by one unlucky event, one black swan. We focus on the wins, which distorts our view.
And Bill Gates had that great quote Housel mentions, "Success is a lousy teacher."
Right. It tricks smart people into thinking they can't lose. They forget luck played a part.
And that overconfidence, that blindness to luck, paradoxically makes them more likely to eventually lose big.
So the big challenge is, how do we actually factor randomness, factor luck into our thinking and planning when we're so wired to ignore it, especially when things go our way?
It's tough. And Housel's advice here is interesting. He warns against obsessing over the specific individuals who achieve massive success.
Like the Bill Gateses, the Warren Buffetts, the Rockefellers.
Exactly. Their stories are amazing, but they are extreme outliers. A unique mix of talent, timing, and, yes, a hefty dose of luck. Trying to just copy their exact steps is usually pointless.
He uses John D. Rockefeller as an example. Built Standard Oil into a behemoth.
But how he did it, I mean, he bent or broke laws, used ruthless tactics. A judge basically called him a common thief in how his business operated.
Yeah.
Now, looking back, people might say, oh, he had vision. He didn't let rules stop progress. But Housel asks, what if he had failed?
Right.
What if a few court cases went the other way? Or the political winds shifted slightly earlier? He wouldn't be a titan of industry. He'd be remembered as a failed criminal. The line between those outcomes is often razor thin, and luck plays a huge role.
So his success, while immense, isn't really emulatable because you can't replicate his specific circumstances or his luck?
Precisely. Same with Buffett. You can try to mimic his every move, but you can't replicate his temperament, his decades-long time horizon, the specific market conditions he benefited from, or his lucky breaks.
So chasing outlier formulas is a dead end. What's the alternative then?
Stick to broad patterns. Look for principles of success and failure that show up again and again across many people and situations. The more common the pattern, the more likely it's applicable to you.
Okay, so instead of trying to pick stocks like Buffett, maybe focus on the broader principle of long-term investing or diversification.
Exactly. Or Housel mentions things like studies showing people are happier and more productive when they feel they have control over their day, autonomy in their work.
Ah.
That's not about one specific billionaire's journey. That's a broad, robust finding about human well-being that has financial implications. It's something you can potentially act on in your own life.
Find those repeatable principles, not the unique lightning strikes. Makes sense. Okay, so if we focus on patterns, not outliers, to navigate luck, what about another big human factor, envy? Housel says capitalism is great at creating wealth, but maybe even better at creating envy.
Yeah, and he argues that envy is incredibly dangerous for our financial health. More dangerous than we often realize.
It's that constant comparison, isn't it?
Totally. He gives the example of a rookie baseball player making, say, $500,000 a year. Objectively rich, right?
Absolutely. Set for life, arguably.
But put him on a team with Mike Trout making $36 million a year. Suddenly, that $500,000 feels like peanuts. His own wealth gets psychologically crushed by the comparison.
And it just keeps going up the ladder, right? House points out that to be a top 10 hedge fund manager in 2018, you needed to pull in $340 million that year. Makes Trout look like small change.
It's this constantly moving goalpost of enough. The comparison game means true satisfaction is always just over the next hill. It feeds this insatiable appetite.
And the danger isn't just feeling bad, it's making terrible decisions because of that envy. He tells the story of Rajat Gupta.
Oh man, that story is chilling. Born poor in India, works his way up, becomes CEO of McKinsey, retires with $100 million. Amazing success.
More money than anyone could reasonably need.
But he was envious. He wanted to be a billionaire. He wanted to be in that next, even higher league.
Despite already having won the game by any sane measure.
So in 2008, he's on the board of Goldman Sachs. He gets inside info that Buffett's about to invest $5 billion during the crisis.
Yeah.
Super valuable, non-public news. He immediately calls a hedge fund manager. They buy shares. Classic insider trading. Makes an easy million, then gets caught up in more dodgy deals, racks up $17 million illicitly.
All chasing more when he had so much. And the end result.
Prison, lost his reputation, freedom, everything. All driven by that envy, that need to keep climbing the comparison ladder.
It's such a stark warning. Envy leads to terrible judgment calls, and the potential cost reputationally, legally, emotionally is almost always way higher than any money you might gain.
Yeah, Housel uses that metaphor. If you have an insatiable appetite, you just eat until you get sick, and throwing up is way worse than any meal is good.
Knowing when enough is enough? It's not settling, it's self-preservation. Recognizing that chasing everything can lead to losing everything that matters.
And this idea ties right into another crucial point Housel makes. Getting rich is often easier than staying rich.
Wait, really? That sounds backward.
It does, but think about the mindsets involved. Making money often requires risk-taking, optimism, maybe being aggressive.
Pushing boundaries.
But keeping money, that requires a different skill set. It requires prudence, humility, and maybe most importantly, a healthy dose of fear. The fear of losing what you've gained.
He uses Jesse Livermore, the trader, as an example here.
Yeah, legendary trader. Made a fortune, equivalent to $3 billion today, by shorting the market before the 1929 crash. Incredible call.
A true master of the universe moment.
But after that huge win, he thought he was invincible, fell victim to that success is a lousy teacher thing. He forgot luck's role, believed it was all genius.
So he kept making bigger, riskier bets.
Exactly, and lost it all again and again. Eventually died broke and by suicide. A tragic story, but it highlights the difference. He was brilliant at the making, terrible at the keeping. He lacked the humility and fear needed for preservation.
And it's not just Livermore. Housel points out that something like 40% of all public companies eventually lose basically all their value.
Yeah, they go bust or fade away, and the Forbes 400 list turns over significantly every decade. Staying at the top is hard. Wealth is not static. It needs constant, careful management.
So the key to keeping it isn't necessarily more genius risk-taking.
No, it's often perseverance, sticking around without getting wiped out. And that often comes from, as billionaire Michael Moritz said, being scared of losing what you have. That fear makes you evaluate potential gains differently.
You start thinking, is this potential upside really worth risking what I've already built?
Precisely. That prudent fear leads to better long-term decisions, focusing on survival and resilience over chasing every last dollar of potential gain. It's about playing the long game.
Okay, so keeping wealth requires humility and fear. But then there's this other fascinating, almost liberating idea, household presence. You don't actually have to be right all the time to win. In fact, being wrong a lot can be part of a successful strategy.
Yeah, this one feels really counterintuitive, doesn't it? We're so conditioned to think mistakes are bad, perfection is the goal.
Right. Get the best grades, make the best picks.
But Housel argues you can be wrong, even wrong often, and still end up incredibly successful financially. He tells the story of Heinz Berggruen.
The art collector.
Yeah. Fled Nazi Germany, ended up becoming one of the world's most important modern art collectors. Started small, bought a Paul Klee watercolor for $100 in 1940.
And eventually amassed his collection worth like $1 billion with Picasso's Matisse's.
Exactly. But how did he do it? Research cited by Housel from Horizon Research found that great collectors like him don't necessarily have a magic eye for picking only winners.
So what's the secret?
They buy vast quantities of art, loads of it. Most of it turns out to be, dubs, doesn't appreciate much.
Okay.
But a few pieces turn out to be masterpieces, huge winners. And those few massive successes, especially held long-term, more than pay for all the duds.
So it's not about batting 1,000. It's about hitting a few grand slams that make all the strikeouts irrelevant.
That's exactly it. It's the long tail principle. A small number of events or investments can account for the vast majority of the results. In investing, a few big winners can drive almost all your portfolio's returns over time.
Failure is part of the process of finding those winners.
Totally. Housel's got that great line. When you're sitting on one Picasso, you don't have to worry about the 99 duds in your collection.
I love that. It really crystallizes the idea. One huge success outweighs tons of mediocrity or failure.
And this applies way beyond art. It's fundamental to venture capital, stock market investing, anything where outcomes are really unevenly distributed. Think about index funds. They buy everything, the winners and the losers, knowing the winners will dominate over time.
It takes the pressure off needing to be perfect with every single choice.
Absolutely. It gives you permission to make mistakes, to try things, knowing that as long as your overall strategy allows for those big winners to emerge and compound, you can still do incredibly well. It's about the portfolio, not the individual pick.
That feels like a really powerful and frankly quite relieving lesson for anyone managing their money. Embrace the imperfection, focus on the long game, and diversification.
Definitely.
Wow. Okay, we have covered a lot of ground today.
Yeah.
From how our personal past shapes our financial present
The personal lens?
to how surprisingly new all these financial tools really are.
Making us all greenhorns.
The huge, often ignored role of luck and why we should focus on patterns, not just outliers.
Right. Avoiding the outlier obsession.
The real danger of envy driving bad decisions and the importance of knowing when enough is truly enough.
That crucial difference between getting rich and staying rich.
Requiring that humility and fear.
Yeah.
And finally, this idea that you can be wrong a lot and still win big thanks to the long tail.
Yeah, embracing imperfection.
So pulling all this together,
Yeah.
what's the big takeaway for someone listening?
Well, I think the ultimate insight from Housel, connecting all these threads, is that understanding this human psychological side of money isn't just, interesting trivia. It's deeply practical.
Oh, so?
Because recognizing these forces, the biases from your past, the pull of envy, the tendency to ignore luck, the difficulty with new concepts, it helps you make more informed, more grounded decisions in your own life.
Like being aware of why you might feel a certain way about risk, or why seeing someone else's success makes you want to take a gamble.
Exactly. It gives you that moment of pause, that self-awareness. Maybe you recognize, that feeling of envy is pushing me, or am I avoiding stocks just because of what happened when I was 20?
Yeah.
It lets you step back from pure emotion or old programming.
It moves money decisions from being purely reactive to being more conscious.
Right. It helps you align your actions with what you truly want, managing your own psychology around wealth, greed, and happiness, rather than just being driven by hidden forces. It's about understanding yourself to manage your money better.
So maybe the provocative thought to leave everyone with is this. If you're not consciously thinking about your own psychology, your own history, those emotional triggers when you make financial decisions, are your choices really rational?
Good question.
Or are you just running on autopilot, repeating patterns you might not even realize are there, maybe patterns that aren't even serving your actual goals today? Something to really chew on.
Definitely food for thought.
Well, that brings us to the end of another deep dive. We really hope this journey into the psychology of money has sparked some new thinking and giving you some valuable perspectives for your own financial path.
Yeah, thank you so much for joining us. We hope you keep questioning, keep learning, and keep diving deeper into this fascinating intersection of money and the human mind. Understanding ourselves is often the first step to better financial outcomes.
Couldn't agree more. Until next time, keep exploring, keep growing, and keep making those informed, very human-centric decisions. Goodbye for now.
Bye, everyone.